Easy money was a drug. It made us feel rich, powerful, unstoppable. Interest rates at record lows, banks lining up to lend, investors convinced the only way was up. But the party's over, and now 2026 looms like Judgment Day. Some will make fortunes, others will be broken, and the difference won't be luck, it'll be strategy. Today, Kelly Eckhold, Westpac's chief economist, tells us what separates winners from losers in the year that could define a generation of Kiwi investors.
Financial freedom faster. Financial freedom faster.
If you're waiting for the perfect moment, you've already missed it. The market doesn't wait, it moves. And the Mortgage HQ snapshot isn't polite. It's a slap in the face, the kind that wakes you up, gets you off the fence and into the game. Take the shortcut. It's direct, it's sharp, and it's sitting in the description. Kelly, you've called 2026 a decisive year. What makes it such a turning point for New Zealand investors?
Well, it should be the year where we actually get out of this funk that we've been in for about a year and a half, I suppose, and a year where we genuinely can see trend growth. It should be a year where the unemployment rate is falling reasonably steady, so people should perceive that and behave that way. And also, hopefully by then, Donald Trump will have sorted out what he's doing with the global trading system as well. And perhaps that uncertainty will have been reduced and people can be getting back on with the business of making some money.
And what will the property market look like when the OCR does bottom out at 2.5%?
We're having another look at our forecast now, but right now that forecast for house price growth next year is still around 6%. It actually could end up being a bit stronger than that, because one of the corollaries of having a lower interest rate path now is that you should expect more of a bounce back later on. When we put together our house price forecast, it was predicated on the idea that the OCR would bottom out at 3%, and now it's not. Doesn't look like that's going to happen. It looks like it'll be 2.5% or something like that. So that's going to have an impact. I mean, it is balanced a little bit by some of the more recent house price data has been disappointing. The Reserve Bank, for example, made a very large downward adjustment to their house price forecasts last week when they presented them. They're basically saying that house prices won't really rise this year, but they think they'll rise by 4% next year. I suspect they probably are closer to the mark in terms of what might happen here for the next couple of months. We're probably going to see prices still fairly flat, but probably picking up towards the end of the year. But I think next year you should expect a stronger outcome than 4%.
Well, it's totally foreseeable that if we rise so far above the trend line that we might spend a little bit more time below that trend line. Now, mortgage rates, you mentioned 4.5% is a likely scenario that we might get to. Is that going to help ignite a boom, or you think household spending is still going to restrain homeowners and renters?
Oh, I think it'll progressively support consumer spending over time. So one of the things I was actually just looking at this morning was the relationship between reductions in interest rates paid and the amount of money paid on mortgage principal. And what you tend to see that as interest rates fall, people do actually pay down a bit more principal, right? So some of that money that they're getting through lower debt servicing costs is saved implicitly by paying down the mortgage a bit faster. But if I look at the net between those two effects, you still see a reasonably significant injection into disposable incomes that will be spent in the economy. I mean, we're, I think, going to really see that emerge in the data in the next few months, because we've had this big pipeline of rate cuts. For a while there, people stuck with the more expensive, shorter mortgage rates because they thought there were going to be a lot bigger reductions to come. More recently, people have really started to move into sort of like those 1 and 2 year rates, which are quite a lot lower. That's going to still continue in quite a large volume in the next 6 months. We're still in a situation where half of the mortgage stock is going to reprice in the next 6 months. So basically that effective mortgage rate is going to move from, currently it's sitting somewhere around 5.6, 5.7%. It'll probably be a bit under 5 quite soon.
And what's the role migration flows are playing in reshaping the housing demand side of things?
Right now, migration is not a strong driver of the property market. It's probably one of the factors why why house price trends have not been as strong as what we might have expected if you'd asked me a few months ago. That labour market is still encouraging people to move to Australia, for example, as opposed to stay here. Population growth on an annual basis, it's really closer to half or 0.6%, which is substantially below the sort of long run average, where you might sort of think about 1.5% would be a bit more normal. But as the economy picks up, we normally see those sorts of things pick up. So I would expect that the net outflow of migrants to overseas would start to be curtailed, and population growth will start to pick up, and obviously that's a supportive factor for things like the property market.
And what's going to impact the inflation side of the equation? Are we going to see a resurgence there? Are we going to see prolonged stagnation? RBNZ has indicated more rate cuts, but they've left themselves wiggle room, haven't they?
Yeah, they sort of have. And, I noticed the chief economist, for example, for the Reserve Bank was reasonably a little bit cagey. He wasn't necessarily promising us everything. Their problem is that for the next 6 months, inflation will be printing either at 3% or even over it. So they're going to have to tell a complicated story here, aren't they? Where they're really telling people, don't worry about 3%. It's going to be 2% soon, and we can still cut rates. It's actually quite a difficult story for them to tell. I think one of the things that may become an issue for them at the end of the year as they get a bit closer to the forecasts for where inflation will be for the last quarter of this year and at the start of next year, is they'll realize that inflation rate probably isn't going to fall as fast as they forecast. No, they've basically got inflation heading back to 2.2% next year pretty quickly. I would suggest that there might be a bigger risk that it really gets back to close to the 2.5%.
Yeah, well, it's probably lucky for investors that the inflation reporting is quite delayed. So hopefully we have lower rates for longer. Which regions of New Zealand are standing to benefit the most from this new cycle of lower rates?
Well, at some stage, the urban areas should really start to join the party here a bit. I mean, we're still seeing pretty decent house price trends in the regions I've been talking about for a while, down the South Island and some of the kind of more rural orientated areas. But in the cities, the lower mortgage rate, that's going to have a much more tangible impact for them. They're not sitting there thinking, oh, there's a big milk price payout, so therefore I'm getting richer. They're waiting for something tangible to impact on them, and a lower mortgage rate is going to deliver that. And ultimately, as employment growth starts to pick up at the end of the year as well, that will also be something that will really benefit those areas. So we might see a bit of a rebalancing of house price growth, perhaps a little bit less of the regional stuff, a little bit more of the urban stuff. I would say that's a very common cycle that we see in the housing market if I look at previous periods.
And what about the divergence between commercial and residential property? Are they going to be impacted differently?
They might be. Actually, the commercial property people sound a little bit more optimistic now because they've seen this investment boost policy that the government has announced back in the budget. And one of the things that it does allow is you can obviously expense some buildings that you build as well. So I have heard there's a few people looking at that thinking, oh, maybe this just changes the economics a bit in our favour. And also they are benefiting from the lower financing rates as well that are now available, given the market is expecting these 2 extra rate cuts. So that's obviously reducing the hurdle rate of return that they have for getting involved in some of these things.
I was reflecting back on some of my 2021, 2022 numbers recently and saw my interest rates, 2.29%, and have experienced a bit of pain of being on some 6.5%. Now down back closer to 5%, thank God. What lessons should investors, next generation of investors, take from this last decade of easy money?
So I think what goes around comes around is a very good message to kind of think about. I continue to believe that period where interest rates got down into the twos was not a positive experience overall for the country. And you could see that reflected in the volatility in those house prices, where it was very much a bubble. It didn't last because it wasn't really fundamentally based. And probably it hurt a few people as well, particularly if you're one of the unfortunate people that did get invested in 2021, because you really is, you are nursing some reasonably significant nominal losses there. Going something through the middle, I think, is a better strategy. And I guess the message I continue to say to people is I wouldn't hold out for 2 point something or even 3 point something mortgage rates anytime soon. And if you do see it, it won't be for a good news story. I think you'll have other things on your mind rather than your lower mortgage rate if that actually occurs.
Yeah, well, the 2.99 for 5 years was the bargain of the century. So anyone that took that, well done. Now, we have indicators that rate cuts are coming, which is great news if you're borrowing money or you've got a lot of debt. But what are the macro events we should be considering and looking out for to predict being blindsided by something that could ruin 2026 for us and flip the script to being, it's not a good year?
Yeah, well, I think front and center at the moment remains that global situation. And there is a bit of a fight brewing in the United States between Donald Trump and the Federal Reserve. And I think we're going to see some fireworks there this month that we perhaps haven't seen in a very long time. I think the people deciding US interest rates are going to have some pretty divergent ideas on what the appropriate policy prescription is going forward. There's going to be a group of them that think that interest rates should be cut quite aggressively, and those are Donald Trump's men and women. And then there's going to be a group of them saying, well, it looks to me like this inflation rate here could be going to 4%, maybe 5% in the next year as the costs of tariffs get passed through. And they'll be arguing that there may be not much scope at all for interest rate cuts. So how that goes, I think, will be quite important in working out what the direction is of global interest rates. And you've got to remember that especially for longer term fixed rates, the global interest rate is quite important compared to the OCR. Useful to think about, that those 2 and 3 year rates at the moment are getting down quite a bit. And, it could be that those rates start getting pushed up because wholesale rates get pushed up because something happens in the United States. That's a reasonable risk. The other thing we have to kind of look at is what happens in Australia and China as well. This Australian economy is actually starting to respond a bit to the interest rate cuts that have already been delivered. As I said, the market is already speculating that perhaps interest rates there won't fall quite as fast as what, for example, my colleagues in Australia are currently thinking might be the case. So that could have a flow through to New Zealand. And obviously how this trade war impacts China will be critical because the strength of that Chinese economy is important for how our export community continues to fare. It actually looks pretty good out there at the moment for China. Consensus forecasts for China have been marked up a bit because some of those real worries that people had a couple of months ago have sort of like calmed down a bit. And I guess the other thing domestically, which will remain front and center, is how does the labour market respond in the next 6 months? Are we going to see the unemployment rate top out where our current forecasts are, where it maybe tops out around 5.3%? And critically, will we start seeing employment growth in the last quarter of this year? Because that employment growth, I think, will be the keystone for when you can be sure that we are actually on a sustainable growing trend. That's the thing that the Reserve Bank was particularly worried about last week when they threw a bit more stimulus into the mix. It's something that I retain confidence that it is going to occur, but we haven't seen it yet and we need to see it.
Fantastic insights, Kelly Eckhold, Chief Economist, Westpac. Appreciate your time and look forward to chatting again soon.
Thank you.
You want ammunition, moves that work, tactics that win? The 3 property formula is the playbook smart Kiwis are already using, while the rest are still refreshing Trade Me and panicking at interest rates. No fluff, no webinars, just results from the front lines. Get the strategy and own the edge. Grab the book before someone else buys your future.